Hey folks, welcome to Pro Trader Strategies. My name's Eric Wilkinson and this is Spotting the Trade using options. So what we're going to do in this video is talk a little bit about swing trades, how we spot those, and then layer on top of it option strategies are best suited for our directional assumption. I talk about it all the time. It's not just a long call spread for a bullish assumption every single time. You have to pick the time and the place that's most appropriate for that type of strategy. So we talk about that in these videos. I build from simple concepts to real life examples in this. And by the end of it, I think you'll have a pretty solid understanding of what we're talking about with this strategy. This is going to be layering in a couple of different strategies together. So we are at the tail end of this particular course. So I'm kind of expecting some of you folks have been already watching in the past and ready for this coming forward. So bear with me as we get through this. If you have any questions, comments, throw it over there. I'm going to make sure you're clear concept before we move on. All right. So these are the exotic strategies. I just call them the exotic strategies because they have some nuances with them that layer on some other strategies. We break maybe a butterfly and do several things like that. That creates the exotic strategies that most people haven't heard of. But this was one of the most popular strategies on the floor, and it is the long put Christmas tree. If you are an institutional trader, they feel like they can spot where this underlying is going. You always hear them talking about prices for different underlyings. Well, they believe that wholeheartedly and actually will wrap around a strategy to that assumption. This one is when we're picking the price. We have a feeling an underlying is going to migrate to a certain strike location. This is a great strategy for something like that. We can break the wing, increase our probabilities of success with this strategy, and I'll show you how to do that as we go along here. But this is going to be on the long put Christmas tree for swing trades using options. But first, let's talk about these swing trades and how we find or spot these types of strategy or opportunities in the market. Now, I want to break this down to a simple concept here, all right? And what do we know about markets, right? Well, a couple of simple things is we have a bullish move, a market neutral move, or a bearish move, right? So if I'm looking at it this way, I'm looking at a bullish move. That's a very bullish move. A bearish move, right? And then we also have our market neutral type of moves where they're just always trending sideways. Now, the next thing, we never see anything straight line like that. I get it. But what I want to show you is there's ebbs and flows in the markets all the time. Even in a bull run, we will see the markets rally, pull back, rally, pull back, rally, pull back. All right. And they're constantly doing something like that. Same thing on the side moves. You can see a couple moves like this and boom, 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 right? So those are things that we see all the time. If you kind of blur your eyes even and you're looking at charts where they are always kind of in a move up or down, right? So that is following the trend or identifying the trend where it's bullish, bearish, or market neutral. Then once we have all of that determined, we want to kind of look at it and see where we could draw a line. If you are aggressive, you're going to draw this line in where it touches as many of the tops as you can. If you are less aggressive, you're going to try and pick the ones that's a little bit further away. You'll have less contact points, but you will find a more of a higher probability trades on those outer bands there, is the way I want to say it. So an aggressive trader in that regard would kind of pick something like this, where it's clipping as many of those on the upside as it can. Now, I don't think an aggressive trader would be this aggressive to try and click that one, but he would probably come somewhere in and around there to make sure that we clip that line. A less aggressive trader would then pick the lines that are rarely touched kind of there. All right. So a little bit, just a little step further out. Again, I would probably say a less aggressive trader would pick something like that. And a more aggressive trader would, a more aggressive trader would pick something like this. A less aggressive trader would pick something a little bit further out in the line there. So that's what we're looking for on support and resistance. Try and draw your lines in there. You can use Fibonacci's. That's what a lot of folks like to do. But this is kind of in one of those wheelhouses where you can kind of sometimes see these Fibonacci's not necessarily being, especially on a vertical rise. You don't get those trend channels as much as you would on a neutral one there, right? So we've identified the overall trend. We've identified the support and resistance. The next thing we want to do is identify the pattern or the shift in momentum really off of one of our support and resistances. That's what we're looking for to key in on, all right, is this pattern. That's where we're going to base our trade on. So despite the fact that it might be a bullish trend, I am looking for, in this bullish trend, the bounce off of a support or resistance, in this case, a resistance, and that reversal of momentum is where I'm going to base my trade here. And again, pattern reversal off of those moves, okay? And really, there are about 5 candles that I want you to really concentrate on. I'll talk about that in just a moment. Let's look at a real life example real quick of, if I can find my mouse, hopefully where'd you go? Let's just send it there and move it. All right, so here we have a real life example, an old example of IBM. I'm going to kind of play this out for about the last year for the most part. You can see this is basically back in April, and this snapshot was in April here. So several months away that we're just going to kind of walk us through this. But what we're talking about with finding the overall, we can see it's a neutral trend, right? But now what we're looking for are support and resistances for this underlying. Now, I would say, you know, a less aggressive trader or somebody might pick this Fibonacci. I would have a tendency to see this line right in here where I can kind of clip through these and come across. It's a little bit more aggressive than that Fibonacci there. And again, I'd probably pick something along this line as being more aggressive, somebody else less aggressive picking this gold line out there, okay? Now, I want you to key in on 4 specific candlestick patterns, or candlesticks in general, mutually exclusive here. So you'll have different kinds of hammers. This is a hangman doji. You can have it where it's got a little bit of a wick at the top, more of a hammer. Again, if they have the little wick in there, you got this is a spinning top then, and then filling out to the bottom. So really, these are just inverted to look that way. And another one, which is the bonus, is the one that looks like a tombstone, and that is called the tombstone candlestick. Very rare, but very powerful when you see that at the top and bottoms of moves. And when I'm talking about this, this is what I would say is the top of a move. It comes up very close to that area, another top of the move. Now we can see in here, there's one right inside of there. That is in the middle of all of this consolidation. It's not going to carry the weight as it would if it is one of those outlier type of candles. You know, like this being a very outlier, popping way above. All right. So those are what we're looking for. And they could be in green. So we could see a green candle looking very similar. The bodies could be slightly different, maybe even a little bit narrower. Okay. So we're looking for very similar patterns to something like that, all right, or filling in at the bottom. And, of course, we've got our tombstone doji. Now, I've got a neutral overall trend, right, neutral trend. I've also found the support and resistance. Now I'm keying in on this candle right there, which is one of these. Now, an aggressive trader can trade off of the candlestick. These are all called the setup candle, okay? Setup candles. Confirmation candles is what a newer trader should look for or key in on, or somebody that has a lower risk tolerant trading profile, all right? So those are the candles we're looking for, and lo and behold, we got one. Now, what I'm talking about waiting for that confirmation is if you were less aggressive, you would wait till you got a confirmation, meaning you got a dark candle that closes out below the previous day's low there, meaning I would get one of these patterns and then get this dark candle right next to it, that would be a confirmation of a top, okay? Even if it's green, you know, confirmation, that would indicate if it closed out below this low, a confirmation of a top, meaning the market is rolling over. All right, so that's what I would be keying in on here. Now, your option strategy really is determined by the environment around it. And I'll talk about that a little bit more. How you doing? As we go along here, I guess I'm not sharing the screen, folks. You guys jumping on me here. So these are the candles we're looking for here on that type of chart pattern setup. Sorry, I thought I was sharing this here. So a candlestick, hammer, hangman, doji, and all of these dojis are what we're looking for. They can be, like I said, green. Less aggressive trader would need to wait for us to see that pattern get confirmed with a red candlestick right next to it. So we're looking for this big red candlestick right next to one of our candles. So a less aggressive trader or somebody with a lower risk tolerance would want to see that right next to it. But sometimes that doesn't happen. All right, I want to fast forward real quick to get ahead of it. I see this as that same neutral pattern. We've kind of come up against this area of resistance. We do have a point of control right here, which is going to be like a magnet, folks. It's going to draw the market to this level, but we also got another one. I thought we had another one on a different chart, a little bit lower. The previous one was right down in and around here at around that 125 mark. That's what I'm looking for in this market move. Now, not the perfect setup. It's not one of these candles that we were hoping to see with a confirmation on it, but IBM has been trading in the same range since I was in friggin' high school, folks. And when we get up in these areas up above 125, it's going to start feeling some weight. And I think that we're going to start rolling over here based on just me trading IBM for the last 20 years, but also because it is bumping up against some of those resistance areas. Now, why would we want to do options instead of just going out there and buying 100 of the underlyings on a bullish market and shorting 100 of the underlying in a bearish idea? Well, the reason why is because when you're using options, folks, you are going to come away with it with much better odds. You're going to have better odds, or better probabilities is what I like to say, but I don't feel like writing it all out. You're going to carry less risk. We can create a defined risk strategy. Yeah, some folks will say, well, I can create a defined risk strategy by using a stop. Well, yeah, but that stop could get set off at any level. When you're using options, you know exactly where your out is because of the nature of buying calls or buying puts and having the ability to be the one in the driver's seat to say, hey, I want to execute this contract or not. Less risk off of that, any type of trade for the most part. And you're going to have much lower margins. I don't care. I can create a strategy using options that mimics exactly what an underlying would do. We call it a synthetic long or a synthetic short. So if it's a long position, you want to make it dollar for dollar, well, we have an option strategy for you on that. And you're going to pay about 50% less in margin. So that's even if you're on a margin platform or a margin trading account, I should say. Lower margin, less risk, I said. At the end of the day, when you got all of this stuff going, folks, you are going to be able to keep your powder dry, which means you're going to be able to stay in the trade a little bit longer. Most of the times when we're buying and selling futures or the underlying stock, we're beholden to every market move. Have you ever bought a stock and it never downticked against you? Like literally you bought it and it only went up from there? No, we all have had stocks go against us. The idea with options is, yeah, that then can go against you. And because you know your defined risk, you can let it play out a little bit longer, allowing you to keep your powder dry. When you have an outright and you're low and behold to the long and short, then you are going to be more emotionally tied to that trade and start making decisions that aren't necessarily the best for that underlying. So in that case, remember when we were talking about with IBM options, why they're a better idea? Well, we had really high volatility during this time. And when I saw that setup candle, not the confirmation, right? This was the setup candle, and the folks that waited for the confirmation would have been very happy when they didn't take this trade. I took it and sold 137 puts up here, and I collected probably like 50 some cents, which increases my break even a little bit, basically $1 above this resistance area. But the market blasted off. I was in it too long. It went against me. I got tested. I knew my probabilities of being tested versus the outright, and that allowed me also to stay in this. So when you guys are trading options, there's a lot of things with this, is we can determine our probabilities of success at the inception of the trade. For instance, in this case, when I set up this trade, I was selling a 16 delta put. All right, that's when we were trading down here. A 16 delta put was at the 137 right mark. I sold that 16 delta put, collected a credit. Now, 16 delta is equal to a 16% probability of going into the money, in the money. All right. That means 1 penny in the money, means that would have to settle 137.01. That is a 16% probability of happening. All right. So that would cause my put to settle in the money in that case. Now, the probability of something like this happening and it going up there and testing my strike, meaning trading that handle, I got a 137 trade on that handle. Well, that's equal to 2 times the delta. The probability of touch is what we call it on the floor. So 2 times the delta tells me that during the life of this option, I have 2 times the delta is my probability of touch, meaning it comes up and hits it, but just that's it. It trades once and it's done. That will help you stay in this trade longer. Knowing the probabilities of it coming up there, hitting you, and pulling back away is something that will allow you also to stay in the trade longer. You always have those probabilities in your back pocket. You don't get that when you're buying stock. All right. So in this case, I stayed in it, was able to get it to roll over. Everything started working out. Volatility remained in there a little bit, but the theta allowed me to get out for a profit. Now, again, back to IBM. I'm going to kind of beat this dead horse all day, folks, because, you know, if you're a newer trader, you should seriously consider looking at IBM as something to trade options around, because really for the last 20 some years, it's traded in a relatively tight range. So having said that, it doesn't have a parabolic move, generally speaking. Sometimes you'll get those massive spikes off of it, but look what happened. We came right back down. Now, here is where we were talking about that trade. Now, one might say, well, why would you take that trade? It's in the middle of the move. Well, remember, this was our last resistance area, and know that going forward that becomes a support. If you hit one of those resistance area, I'll repeat, if you hit a resistance area and blow through it on the way back down, it will act as support. So on this trade, what happened was we got that blast off. I was able to stay in it for a little bit. We got a little bit of consolidation. It never really went back up there, so I was able to get out for a profit before the earnings. Got the shoot up, right? 152, serious high for IBM. And then, of course, we roll back over. What do? We go right back down into that range where we've been talking so much about, right? That was the previous range that we were sticking to. But again, bounces off that support, maybe a little overextended at this time, but now starting to revert back. And this is that, you can tell where the old area for the point of control was down here in the 20s, which is what I'm looking for us to revisit now. Again, fast forward, this is that bounce off of that low. What do? Yeah, I thought it was going to stay within this area, but it kept continuing. So our new area of like for a lower risk tolerant person is probably a little bit wider. Be patient and wait for those. But again, one of those candles that I'm looking for as a setup candle at the top of a move. I need to see, if I'm a less aggressive or a newer trader, a confirmation candle right next to it the next day before I would enter that trade. Otherwise, you're being very aggressive. So this person got that confirmation that next day, as you can see, and the market ended up rolling over. So if you're more of an aggressive trader at these big top moves, that would have been one that I would have entered in on. This is one that is one of those trades I would have looked for a trade. Something to note: if the underlying, you put it on this trade, you want to trail where your out is. So a less aggressive trader, this is the first day you put that on this trade, right? Now, the next day we roll over, you would probably want to continue to trail that out like a break above that's previous day's close or something could be your out. Mine is above the previous day's candle is what I look for. Now, again, on this one, it bounced up and rolled over. So you might have been pulled out of that trade if you're following that to a T. Less aggressive traders are going to be getting in and out quicker. All right, so back to my example. I shrunk this down. Again, here is that candle confirmation roll over, and I don't think we're going to have the momentum to make it up there. This was off of this bounce was off of their earnings, mostly due to Azure, which is their cloud services. The street hates them for that cloud services, and I've been thinking that was going to be something to break them out of this for the last 5 years, and it hasn't. So we're stuck with it being in this range for a while now. So I'm looking for a trade to roll over, and I think that we're going to come down to this 125 area, all right? And I think it's going to happen pretty soon. We don't have any worries for earnings, so I don't have to worry about that. Something to note, though, our volatility is relatively low. So with that, I talk about this with strategies. When volatility is elevated, we want to sell options because those premiums are very expensive. And when when volatility is super low, that's when we want to be buying that premium because they're super cheap. So when we have that range, we want to be making sure we're paying attention to where implied volatility for this underlying is in relation to where it's been in the past. I'm not comparing IBM's implied volatility number to Tesla's because they're completely different beasts. That would be comparing apples to oranges, so to speak. But when we're comparing IBM's implied volatility right now against where IBM's volatility has been in the last 6 months or a year, then that is data we can base a trade on because we know that it is telling us if those premiums are expensive or cheap. All right. Anybody have any questions about that? So when volatility for IBM is up here in the 50s, let's call this 50 up here, that would be very expensive for IBM because we know with Greeks, as volatility fluctuates percentage point by percentage point, as it increases 1 percentage point, our premiums increase by that volatility coefficient. That's straight across from that. All right. I'll show you when we pull up the option montage, but that's how it will. And if it starts down ticking like this, going from 50 to let's just call it 30, that's 20 percentage points, right? I'll call it negative 20 percentage points. Well, if my volatility or Vega, if Vega is, let's just call it 25 cents, all right? Well, what's 20 times 25? $5, right? I do that right? 10, $2.50, right? 20 is $5. Well, that means that those premiums, if they decrease 20 percentage points, those premiums decreased by $5 or $500 if you have the option multiplier on that, right? So we want to be highly aware or acutely conscious of where volatility is before we enter the trade, because that determines whether or not we're buying or selling options. So I've got a price location. I want to nail that number. I want a little bit of wiggle room in case this pops to the upside. Not really sure about IBM right now. Azure just came out. That could make it send to the upside. So I want that defined risk. But I think it's rolling back over to that 125 area. So that's where I want to short my strikes. Somewhere in and around that. Maybe 125, less risk tolerant, go to 130 as your short strikes, okay? So when we're building out this long put calendar, this is my area I'm looking for. Then I want to go over here and start with the broken wing put butterfly. You guys remember how we did this broken wing put butterfly? Appreciate you, Dolo. Am I saying that? Dolo? Anyway, so we start out with the broken wing butterfly. Actually, we start out with the butterfly. So let me actually just pull up a platform here and just get rid of all this stuff. Oh, no, I don't want to do that. Let's just delete that. All right, so let's go over here. We want to do a broken wing butterfly, right? So when we talked about the broken wing butterfly, we were buying this one, a regular butterfly. We sell 2 of those, and then we buy that one, right? Well, what I was talking about with the broken wing butterfly is we are breaking the wings. So literally a little bit different. We're skipping the strike, selling 2 of those, and then buying this one, right? So we skipped one strike. That's what breaks the wing, or broken wing butterflies, broken fly, all right? So the broken fly, reason why we do that is to pay down some of our premium. What we're doing is right here, we're selling a call spread, right? So we got the broken wing in there because the 30, usually we go 30, 35, 30, 25. Well, we're breaking the wing and skipping that strike. So that's what allows us, we get a short call spread in here. It's synthetic. Buy one, sell one, buy one. All right. Well, what we're doing is we're getting out of this. We buy one and then sell one to erase that out, kind of. So we're selling a call spread in there to get this to pay off some of the debit. I don't want to pay full boat for this thing is really what I'm thinking. So I skip that strike. It's short, synthetic, short 30, long 25 put spread is in there. And then we got that built out for the broken wing butterfly. Then I have another call spread here where I want to sell the 125, buy the 130. So there's your broken wing butterfly. All right. Now I want to add or layer on another short call spread in here to help me pay off some of this debit, right? So to add that in, I'm going to sell a 25-20 put spread. That gets my credit to go down quite a bit, right? So now, oops, what did I do? I did that backwards. So we got the 20, let's go 35, because I want to get short the 25s. There's your butterfly, your broken wing butterfly. Now I sell a 25, buy the 20 put spread. So that extra put spread in there adds more credit to this trade and lowers the overall debit that I have. Now, when we're adding risk, we are adding reward. So this short call spread gives us a little bit of wiggle room to the upside. All right. So we're not going to get hurt as bad to the upside. And it's still defined risk. So we know our risk reward. Anytime you're doing a debit, that is your overall outlay of risk. Our reward is going to be really this long call spread gains of value, this 30, 25 gains of value all the way up there. So if we can get it to settle right below 25, then we get the full money for this long put spread, the 35-25 long put spread, and then we get all the money out of our short 25-20 put spread. All right. So the short put spreads make money, the long put spread makes money, and if you can get it to settle right below that, you get the full bank. So let me build this out so it's correct here. There we go. So we got 1 by 3 by 2, or on the floor 1 by 3 by 2. All right. So that's the right build out there. Now, if we go over to the analyze trade, I think I got some of those old ones in there, so it's going to make it a bit funky. But you can see it's not like the butterfly. It's got a little bit more of an angle to the downside, meaning I added risk to the downside here by selling that 25-20 put spread, but it gave me a little bit more wiggle room to the upside. So if the underlying doesn't sell off, it gave me some more room to this upside if it starts trading there. Now, if it trades above 135, you know, I'm at full loss, or below 120, we're at full loss. But anytime in between that, we can have our profitability fluctuate within that area. Obviously, settles at 124.99. That is going to be your max, or sorry, 125.01. You'll have max profit. All right, 125.01 right there. All right, so start out with that broken wing, and then you layer on the other trade. So this is our broken wing put butterfly. This is what the broken wing put butterfly looks like, right? We added that short embedded call spread in there, which gave us no risk to the downside. All right, we would be profitable to the downside. And then we've got limited risk to the upside there. That's with the broken wing put butterfly. Then we move over to the short put spread, and it looks like this. Starting to picture this getting jammed together here. If we jam those two together, we've added some risk to the other side. This was the side we've added risk to with that short put spread, right? Here's that short put spread in a different fashion. Got the broken wing butterfly, right? And then a short put spread in there, to create that. So this short put spread right here at the 25-20 adds risk to this side of the trade, but decreases my risk to this side of the trade because of the debit is much less. It gets me more wiggle room to the upside, right? The other one, my risk to the upside was, you know, a lot worse. It was by about $1.05. You can see the short put spread, the broken wing butterfly 278, the broken wing butterfly 278, the short put spread, we gained $1.05. So basically limiting $1.05 in risk to the upside, but we gained some risk to the downside there. Does that make sense for everybody? But when you punch it all together on the platform, holding control down, I have to hold down control and click on all of those to keep them adding up. Otherwise, it just clears it. But adding that control button in there, you're doing the skip strike, sell 3, buy 2. All right. This is how we're going to play that one out there. I wanted to pull up the platform real quick because there's something I wanted to talk about here, and I can't. I was going to try and go through this short put spread again. So the butterfly, 1 by 2 by 1, sell the put spread. So really, here's what I was looking at. This is where I got confused. And I'm sorry, I'm going to probably sneeze here. Sorry. I'm so sorry. All right. So I got myself confused a little bit. Here is your butterfly, right? Did I get the last one in there? And I want to buy that one. That's your butterfly. Now, this is the broken part of it. We're long 30, short the 25, and long this one. So if I sell this 30 to make a short put spread, I want to sell a short put spread. I hold down I hold down the control, click on that. Look how I got rid of that 30 because I'm selling it and then buying the 35. So that's where that synthetic put spread comes in to break that wing. All right. So that put spread, which is valued at, that put spread, we're getting, I want to sell, buy. We pay, $235 for it, but then when I sell that put spread, we're going to gain value from it. All right. We're gaining value from hitting that 350 and getting that short call spread in there. That lowers the overall outlay of capital for this trade. No, we're already at the end. Well, folks, here is the link to that offer. I kind of breezed through this pretty fast without any questions, I guess. But for 36 bucks, that's only a 36-cent option strategy. You guys get all kinds of access to 15 hours of content. You guys will be able to click on it, check it off. It indicates when you're done with that. You can also use rising interest rate, folks. We're talking about rising interest rates right now with the bonds, the 10-year, the flattening of the yield curve, all of that stuff. I go into that detail that you're hearing Rick Santelli talking about all the time. Trading with that market profile, that's that blue section to the side. Really helps us out with swing trades and stuff like that. And really digging into the nitty gritty of when, where, and why we're trading options. I go into different specifics for what I'm looking at for the capacity of you folks. If you're very new to options or trading, I have courses for you folks to kind of layer on and build it up to expert level. Or some of you guys can go straight to that, but you just check off the window and you're good to go. All right. So like I said, if you guys have had a light bulb moment at any point, please smash that like button for me before you go. It sends the bots out there to inform somebody just like you about this. And hopefully they'll click on it as well. And if you have any questions, comments, I will circle back around for you. Finally, hit the subscribe button. I realized that I popped in here a little bit early today because I got an errand I've got to run, a bit of an emergency run here. So I had to jump in right away and get this for you guys. So make sure you're hitting that subscribe button, the little bell right next to it. That will give you guys the heads up that I'm popping in here. So don't forget to hit the bell. That'll let you know when you get the indications. All right. So smash that, or, oh, I wasn't ready for this. So take care. And if you can't take that, take it easy. Bye for now.